Don't you find it a little curious and interesting as to why is it that most central banks around the world, their primary reserve asset is gold, but yet the average person's investment portfolio probably has zero gold? I mean, not our clients, of course. Our clients
Right.
absolutely do own gold.
Once again, I was learning what is money? Why is there demand for gold? Why is gold going higher? Why do we think it'll keep going higher? And how does gold fit into a portfolio such that, once again, it can be your left tackle? And really, people talking about I want to be able to sleep at night. I can sleep really, really well at night knowing we have the best left tackle in football.
No, you Adam, actually sleep like a baby, knowing that we have gold inside of our portfolio protecting our client assets. And if we didn't have it there, I don't think I'd feel the same.
Welcome back to another episode brought to you by Pejovic Bighill Private Wealth. I'm Adam Bighill, and I'm joined by Peter Pejovic. And in the interest of time, let's dive right into today's episode. So, if you have $1 million invested in your portfolio and you take a look at what you own, you notice you don't have any gold. You have to ask yourself why. In this podcast, we're going to dive into why we think you need to own gold and why we think it's going higher. In order to understand the pivotal role gold plays in the global monetary system, you first have to understand really what is money. And money really can be defined in three simple tests. Number one, unit of account. Simply a standard of measure used to express value for goods, services, or assets. Two, medium of exchange, an object that is generally accepted as form of payment for goods or services. And number three, store of value, the ability for money to be held and used for future purchases later in time. So, good little intro to what is money. And if we look at fiat currency like the US dollar, it has served all three of these definitions. But in reality, the store of value definition has only been in place since 1971, and that would be after Nixon ended the dollar to gold convertibility. Remember, prior to 1971, gold partially backed in every US dollar out there. And that essentially was the store of value behind each dollar in circulation. And once this ended, the store of value of that dollar was really then tied to energy demand and oil with the Saudis through the petrodollar system, and not gold anymore, and essentially nothing physically backing that dollar.
Yeah, Adam, the most important takeaway here is the moment no physical restriction was put on the growth of money supply, for example, a percentage of gold to be held for each new dollar put into existence, you now have a dollar that has a store of value which equals that, essentially that government's credibility or fiscal responsibility. But it's not like it was in the past where if a government wanted to increase their money supply, they first had to go find gold. They had to increase their gold stores. They had to go mine it. They had to buy it. They had to store it. They had to process it. It wasn't easy. There's limits, put into place as a result of that. Whereas post 1971, those limits were essentially removed.
Yeah, no, that's exactly right. And I mean, I guess therefore it should be easy for everyone to kind of now understand why a dollar in 1913 is really only worth 3.5 cents today. So you have to ask yourself, how is that for a store of value? Am I right?
Yeah. Not a very good one. At the end of the day, if you just literally took your surplus savings and stuck it into dollars and passed them down the generations for 100 years, there's basically nothing left.
It's really
in terms of your ability to buy anything with that.
Of course. And that's kind of why we want to do this episode and really talk about gold and its store of value. Since nearly the beginning of time, gold has been an agreed upon medium of exchange and store of value. Gold is scarce. It is a hard asset, meaning
it's years.
Yeah. And it's a real tangible thing you can hold in your hands. And it's very hard, like as you mentioned, to mine, refine, produce gold, let alone find it. And there's a lot of cost that goes into that. And compare that to really the cost and what it takes to printing money. A very different scenario there. I think you can kind of see that, maybe the most important difference there is a limitation. Gold production is limited by many factors. It's a non-renewable resource that you have to find. And it has to be economical. It has to be economic sense and feasibility of pulling it out of the ground, where printing money is essentially limitless.
But the question I keep getting from clients in general is, Peter, is this going to make me any money? Or, will I make money in gold longer term? And while that may be the most popular question that we get from clients, it's not entirely the right question the way we see it in terms of building and preserving wealth. And that's key. Building wealth and preserving it over not just a few months or a few years, but really over generations, even as you pass it on to your children and grandchildren. So let me answer the first question, and then we will address maybe a better or the right question should be in just a bit. So, Adam, what do you think? Like, if you asked a random investor, a random person on the street, say since the year 2000, since the turn of the century, what performed better, gold or the stock market?
Recently I've been testing this on different people I'm coming across,
Yeah,
especially some of my teammates, and
yeah,
I've all said the U.S. market, the S&P 500.
yeah. That's
Yep,
what I same thing. I've been doing the same thing, testing people just for fun, just asking the question. So, what do you think did better? Gold or Standard & Poor's 500 since the turn of the century? And virtually almost everybody says the stock market, the S&P 500. And of course, you and I both know that would be wrong in
that's right.
general. If you actually measure the performance of gold since January of 2000, turn of the century till present day, it's up over 1,200%. So just absolutely huge returns on gold since the turn of the century. But if you then measure the returns of the S&P 500 price index, let me just take a look over here. Yeah, it's about 365% return. Now, if you take the price index and you add dividends to it, someone out there is going to be screaming through their screen right now saying, you have to include the dividends. And they would be right. You really should probably include the dividends. So even if we include the dividends, the S&P 500 during that same time period is up about 650%, which is pretty good. It's not bad,
So
but
you're
it's
you're
not what
saying,
gold.
yeah, we just talked about, you want to make money, nearly double the return, nearly
Yeah,
in
nearly
gold,
double
in gold
when you include dividends.
when you include dividends, and nearly 4x when you don't.
That's right. Yeah. So gold, to be clear, has performed better than the US stock market. And by the way, the US stock market literally is, over the last 25 years, if not the best performing stock market. It's right up there in terms of industrialized, like large G7, G20 industrialized nations. It's the best market. There has been.
Yeah, absolutely.
Yeah. Yeah. So gold demand has been increasing for over a decade. Adam, want to talk a little bit more about that?
Yeah, we clearly show that gold is here as an asset that you can buy, and as we'll explain why you should own it more in detail, but certainly makes money. So it should be on your
Yes.
radar to very start. But in terms of what is driving gold prices, especially recently, the first thing, yeah, you have to point out is demand. Demand for gold at the central bank level has only been increasing, and it's been very evident from 11 years ago. But even as much as where we are today, foreign central banks have gold market values now that have eclipsed or just about to eclipse that of their treasury holdings. So, but it's clearly telling us something, right? It's telling us that the demand for gold is increasing drastically.
You're talking about central bank reserve assets. Like what central banks around the world hold as reserve for what? For future purchasing power.
Correct. Future purchasing power. And that's an important takeaway. Like, why do central banks hold reserves? What do they do with those reserves? Those are there for economic stability and prosperity for their countries as they see fit in terms of what they feel like they're going to need. And while that changes over time, these viewpoints generally are decade-long viewpoints that they have to be able
Yes.
to look into the future and assess what is energy demand? What do we need? What do we produce? What do we need to import? Do we need to change the direction that we're going? These are all long looks that they're taking. So when central banks are taking long looks at gold, you need to take attention. Wouldn't you agree?
Well, I would. Don't you find it a little curious and interesting as to why is it that most central banks around the world, their primary reserve asset is gold, but yet the average person's investment portfolio probably has zero gold? I mean, not our clients, of course. Our clients
Right.
absolutely do own gold, but I'd say the average investor out there probably does not own gold, but yet the average central bank out there does own gold in huge quantities. What do you think? I
Yeah.
mean, that's kind of curious. Like, what do they know that we don't?
Even as much as 3 years ago, levels of net purchases of gold by central banks have nearly been at all-time record levels. We're talking massive, massive demand and buying. Demand is there, but Peter, maybe let's talk a little bit about why the demand is there. And anytime you're buying an asset, you're buying something to make money. We hope you're not doing it based on just, past performance or, someone saying this is a good investment, you should buy it. You really feel like you should know why. Why are things happening? And when we are working with our clients, we absolutely have to have a deep, meaningful why to everything that we own. So Peter, maybe talk a little bit about why the demand is rising and what has really been the shift here.
Yeah. So, like, why is literally the most important question. And if you understand the why, then you will probably understand, the what is it that central banks know that the average investor clearly doesn't know. And there's probably many things, but one of them, if I can speculate, might be gold is a monetary constant. And sometimes I tell that to clients and so forth, and they first look at me in a funny way, saying, Peter, what are you talking about? And what I'm talking about is that gold has been used for thousands of years, essentially as money. And so what does that mean? It means that it doesn't really matter if a bar of gold or a gold coin is a year old or 10 years old or 100 years old or 1,000 years old. It's the same. Like it's a constant. That gold, that bar of gold from 100 years ago, it has not changed over the last 100. And there's an old saying about buying a suit that you can go back a year, 10 years, 50 years, 100 years, 200 years, and a really good high quality suit. It was about an ounce of gold. It's an ounce of gold today. It was an ounce of gold 50 years ago, and it was an ounce of gold 100 years ago. Why? So what does that mean? It means that ounce of gold is a monetary constant. And when you can say compare it to the cost of a good suit, it actually hasn't changed, even though that good suit, 25, 30 years ago might have been $300-$400, and now it's $3,000 or $4,000. Again, the cost of roughly an ounce of gold. So when you think of gold as a monetary constant, and you see the price of gold going higher and higher and higher over time, so the question then becomes, Adam, is gold really going higher as, say, compared to the cost of a good suit, or is it that the dollar is going lower? So is gold going higher, or is the dollar going lower? What do you think?
Yeah, that's the absolute crux of it all. And we already said in 1913 a dollar was worth $1, and today it's worth 3.5 cents.
Yeah, no, it's a dollar's going lower. That's what it is. So if the price of this suit is going up, it's not really going up. It's the value or the purchasing power of that dollar that's going down. It just means that the dollar has gotten weaker, and you need more of that weaker dollar than you did in previous years to buy that same suit. And that might explain the next kind of point is, like this, why this sudden change and shift to gold as a central bank reserve asset. Again, what do they know that we don't? And so I think they know what we just talked about, that if you really wish to preserve the purchasing power of your surplus savings, gold historically has been one of those assets, if not the asset, over time to basically preserve your ability to buy that suit, or maybe not just a suit, maybe oil, for example. If you want to be able to, if you're a country and you wish to preserve your ability to buy oil in, well into the future, store gold, basically reserve gold. And that gives you the ability to buy more and more barrels of oil over time. So
without a doubt.
Yeah.
And that's really what store of value comes back to. And you talked about it with the suit. It's more dollars to buy the same thing, or the same amount of gold to buy the same thing. And that's store of value. And that's why gold can make you money. And that's part of the reason why we want to own gold for clients.
Yeah. So other reasons could be rising debt levels. So, when you get rising and higher and higher and higher debt levels, one would assume that over time, the value of the currency that the debt is denominated in will probably shrink and devalue or debase. It's another way to put it. Essentially. So, and it almost has to, because if the debt's gotten too big, you need to decrease the value of that currency to then decrease the value of that debt. But not true if you're holding gold. And for example, here's where we get into a little bit of politics, which we don't like to do. Right at the beginning of the Russian-Ukraine war, the US government and other governments confiscated Treasury assets that were held by the Russians and basically took it. And as much as there's probably a lot of people out there that would think that's a great idea because we're doing the right thing. The reality of it is that when you take treasury assets, which are reserve assets that the Russians held, and you just take it, there's going to be consequences of that. There's going to be a lot of other countries around the world all of a sudden raising their eyebrows going, what if I'm next? What if all of a sudden they don't like what I'm doing or what we're doing and they take our treasuries as well? So that then creates a situation where all of a sudden those treasuries are, as a reserve asset, are not what people might have thought they were in terms of security. And then once again, gold just becomes something that is a little more decentralized, something that you can be removed from, call it the U.S. domiciled monetary system, held as reserve instead of treasuries. That's another reason why gold has been reserved more and more instead of treasuries. Do you remember that, Adam?
Absolutely. And we're talking about what is the sudden change? What is the shift? Why the demand? You highlighted it. U.S. debt at record levels, 37 trillion, deficit 2 trillion. If you hold U.S. dollars as a foreign central bank, and you see the writing on the wall that the U.S. is going to have to devalue their debt, that's concerning as a central bank. So why would I hold your devaluing dollar, right? And I'd rather hold gold. And Treasury confiscations absolutely put everybody on notice. Maybe we should rethink our strategy because, if we ever get into a conflict somehow, some way with the U.S., this could be us next. And I think you mentioned energy purchasing as well, right?
Yeah. Do you want to dig in that a little deeper? Because I think this is a concept that the average person just has not thought of.
Yeah. And
but it's huge. It's a huge
it is a
consequence.
It is a big piece. And like we talked about earlier, central banks are taking a long viewpoint in terms of national security. Energy, without a doubt, is a major national security topic and something that's top of mind.
Biggest.
It's got to be, right?
Literally, energy. If you need to make sure that your country has energy into the future, otherwise you starve to death. You freeze to death.
Even more than your military, because your military needs energy.
And your military needs energy. So energy is of paramount importance to any nation state anywhere in the world. Yeah.
And so back to the store of value and really, what it's costs to buy energy.
Yeah. Like how many barrels of oil would 1 ounce of gold buy? If you're a country and you're thinking, I need to store my surplus savings in something. But if I took that and bought energy with it, what would it get?
Right. And we're to the point now where you're buying roughly 55 barrels of oil per ounce of gold. And so you can see the difference in purchasing power.
Well, wait a minute. How much more? Let's repeat that. From 20 years ago, 1 ounce of gold bought you 8 barrels.
Yeah.
And now, a few years later, 1 ounce will buy you, I think it's 55 to 60. It might even be pushing 60
gold's
now.
Nearly 4,000 right now as we talked. So it'll be pushing 60 barrels. 60 barrels. So
it's a moving target, obviously, because the price of gold and oil changes daily.
Let's just maybe call it somewhere around X in purchasing power.
Right. So let me get this straight. So if you just reserved gold during those years, you can now buy 7X more oil today than you could have. Just stop and think about that for a second.
Yeah. And there you go. Demand at the central bank level starts to make a little bit more sense, right?
Yeah, absolutely. But if you reserve treasuries, you essentially are buying, more or less around the same amount of oil for your dollars. Might be a little more or a little less depending on which year you're looking at, but it hasn't really changed all that much.
That's right. Just simply because the interest rate you're getting on your treasuries, maybe there's a FX gain that you do get from the U.S. being a strong currency over the last couple of decades.
Yeah, minor.
But minor relative to then looking at inflation and what are you left with? It's pretty obvious here. Once again, why the shift? And then, gold keeps going higher. Peter, you mentioned monetary debasement. I kind of talked about it quickly, but we're in a situation right now with the U.S. Fiscal situation where it appears to be really the only play. And we love calling plays and trying to win for our clients, right? And
that's right.
And this is probably the number one play that's, as we see it, that's being called because we don't think the U.S. is going to default. on their debt. We don't think that the US is going to cut any type of entitlements to Social Security, Medicare, Medicaid. That's
Not
probably not going
likely,
to
unless
happen.
they want the pitchforks and torches to come out.
Exactly. So, I mean, they're very limited in what they can do.
Mhm.
And this playbook has been used before, right, Peter?
Yeah. You sound like a coach there, Adam, when you're discussing that.
There you
So,
go.
yeah. So
Get out the X's and O's and the drawing board.
yeah. So, I mean, and the obviously the central banks are already well onto this concept and have been for years. So, if anything, one of the reasons we're doing this podcast is to try to get some of this information out to the general public so they can start seeing things in the ways some of these higher echelons of finance are already seeing things, so that they can protect and preserve their own assets as well, and hopefully make life better for them in the longer term. So really the playbook, Adam, is what essentially don't own just stocks and bonds, correct?
Yeah, yeah, and I think it's a great segue into really
Mhm.
talking about gold as an asset in a diversified portfolio. But you got to understand, we're having conversations with clients that have multi-generational wealth that
Yes.
they want to pass on. That's not meant for just the next 5 years. So, Peter, maybe just talk a bit about how we think about gold as an asset in our portfolios, and really why all of our clients own gold, despite maybe a 5 year timeline compared to a 70.
Yeah. So we've owned gold for our clients for well over 20 years. And so it doesn't mean it has to be your whole portfolio, of course. You should still have a well diversified stock portfolio, have some liquidity through cash and or fixed income like bonds. But then a portion of that should be gold. And again, everyone's risk tolerance and so forth might be different and that amount might vary. But in general, if you have some gold inside your portfolio, and you blended that gold with stocks, it's some very, very interesting things. Like one of the things it actually does is because the two assets are really not highly correlated to each other. You blend them together, both done well, like we said, like 1,200% or so rate of return for gold since 2000. S&P 500 about 650%. So you blend those two together, you end up with a really a strong rate of return over the last 25 years. But the volatility, or how it bounces around, shrinks. It shrinks because they don't necessarily go up and down at the same time. And especially during crisis scenarios. Adam, do you want to maybe just talk a little bit about how gold, real estate, S&P 500 did during some
Yeah,
of the financial crises like we had in the last 25 years?
yeah, yeah. I think it's a great point. It behaves differently, and really noticeably during crises situations. So, '08 financial crisis in the U.S. Gold up 5.5% on the year. S&P 500 down 38.5% on the
Yeah,
year.
on
Real
that year.
estate, real estate down 42.8% on
Yikes.
that year.
I remember that. That was horrible.
That's part of the reason why you have gold in your portfolio, correct?
Well, I remember 2008, we were around during that time. And I remember as bad as things were, and don't get me wrong, things were really bad, out there with stocks being down as much as they were and real estate being down. But when we looked at our client portfolios, yeah, I'll fully admit it wasn't the best year we had, but it wasn't that bad. And the reason it wasn't that bad is because we blended gold with stocks. But at the end of the day, when you averaged it all out, it wasn't nearly as bad as market averages. And the same thing happened during 2020, during that quote unquote COVID crash.
Yeah, gold was up 25.1% during the COVID crash.
Mhm.
At the same time that crash was happening to the bottom, the S&P 500 was down 34%. So
During that drop.
during the drop, and so there was an immediate, divergence there in the portfolio that once again anchors your portfolio to not experience all of the volatility of the equity market.
Yeah, no, and I remember that time very vividly because it really wasn't that long ago. It was just over 5 years ago. But that was a little bit different even than the 2008 crisis, because 2008 was really a financial crisis. But COVID, people not only were worried about, quote unquote, markets crashing and so forth, they were worried about their health. And then when we looked at their portfolios and saw that essentially they were okay. I mean, sure, again, once again, it wasn't amazing time to be an investor, but the the rates of return were quite reasonable considering what was happening, and a big part of that was the weighting that we had in gold.
And so gold fits in the portfolio for many, many reasons. Is
Yes,
really what we're saying.
yes, it does, and that is a fact that we would like to impress upon investors out there, especially if they look at their portfolio and they do not own gold during this environment where essentially we've had bouts of very high inflation, but we have high levels of debt. I mean, we have monetary debasement. Like, this is the perfect scenario really to own gold.
So Peter, gold has obviously done really, really well as of
Yep.
recently. I guess investors and people are out there probably wondering, well, can you buy gold here with the moves that it's made? Can it keep going higher? Can we make money? Well, I guess I'll throw it to you just by saying we do think it can go higher. We do think we can make money, but Peter, make some sense of it.
Yeah, so we're getting this question a lot lately: is how high is too high? I mean, if gold is like literally, um, what's it up this year? It's probably close to 50% or something along those lines this year alone. So is it essentially too late to buy? So, I will issue a disclaimer that sure, if it's gone up that much that fast, there's always the potential for a correction that brings it down to maybe a bit of a cheaper level at some point that people will be more interested in buying it. However, as long as the monetary base is being debased, so as long as we have inflation and as long as the debt levels remain high, there really is no end to this. Just like if you look at over the last 100 years or last 50 years, gold after certain corrections has kept going higher and higher and higher. The same will hold true. So yes, it's subject to potential correction here at these levels. But no, it's never really too late, because as long as we have the current monetary system that we have and debt remains high and money is being debased, gold over time, over long periods of time, will keep going higher. But that's just at a base level. At another level, I don't know, Adam, do you want to talk about the possibility of a gold reset? Is that maybe where you're going as well?
I mean, it's definitely on the table in terms of, like we talked about, what are the options that the United States has? How do they handle this fiscal problem? Well, we know they have what, 8,000 tons of gold,
Little over,
a little
probably like,
over.
yeah, 8,100 tons.
Once again, how are they going to fix the problem? Well, they've alluded to the fact that Besant specifically said this, that
Scott Bessent, the Treasury Secretary.
would they would be looking at monetizing their balance sheet.
Yep, his
Y-
words.
His words.
Yeah,
What does that mean? And as you kind of got to look at, okay, what are you going to monetize? What do you hold that isn't already of
yeah.
monetary value? What can you move the needle on? The only thing that we can really see is gold.
And so, what does he mean by that? When he says monetize the balance sheet, he's talking about those 8,100. Assuming he's talking about those 8,100 tons. He didn't specify, but there's really little else he could be talking about. On their balance sheet, they have 8,100 tons of gold at the price it was in 1973, I believe it was, which was $42.22 an ounce.
That's right.
That's right. So if you do some math, you take, 8,100 tons at 42.22 an ounce. I believe you get something along the lines of $11 billion of gold at 42.22 an ounce. Is gold trading today at 42.22 an ounce?
Not even close.
Not even close. So if you actually took that 8,100 tons of gold and you multiplied it by the current price of gold, which is 38.60 right now, according to my quote screen, that is now over $1 trillion of gold that they actually have. But on the books, it's at 11 billion. So why?
Right. And then the simple move is to revalue it to current market price. Anyone can kind of see, well, that's a no brainer. Yeah. Why wouldn't they do that?
Why would they do that?
But in history, there's no reason why we shouldn't think that they might reset it higher. And why? Well, they've done it before. They have
Sure.
reset the gold price 4 times, I believe, in the course of history from the 1800s.
Yeah. Yeah. 73 was the last one, I believe.
Yeah.
73, I think it was 72. I believe Roosevelt did it in 1934. And I believe the original one was 1834.
Yeah. Yeah, I mean, so
So,
with Roosevelt, right? Like the U.S. made gold over a certain amount of ounces illegal, and you had to turn
yep,
it in.
yep.
You couldn't have stores of gold,
Ah,
and
right before they revalued it, you had to
well,
turn
that's
it in,
exactly right. You had to turn it in, and then all of a
and
sudden,
then they
when
revalued it.
once they got all the gold, they revalued it to a higher price.
Yes.
So, that is a possibility for what could happen here to solve some of the problems the US is having and, monetizing the balance sheet. So this is a real possibility and really where gold can go and where, maybe gold could go up 2, 3, 4, 5x from here.
Yeah, and just to kind of back up a bit, the way this transaction would look, I'm not going to get into the minutia of the detail, but essentially the Treasury owns the gold and the Federal Reserve owns gold certificates. So they would have to do a series of swap transactions at a new price. And again, if they did the current price, you're looking at over $1 trillion that will be essentially created out of thin air, which is not debt. Because currently, if they have to create $1 trillion, they have to issue $1 trillion of bonds, like Treasury bonds, which is debt. But this would create $1 trillion at current prices without actually issuing any debt. Now, that's assuming they did the current price, but what's stopping them from doing it at double the price? And if they did that, it'd be 2 trillion. But why stop there? I mean, if they can go 4 times the price and make it 4 trillion. So now there's reasons why they might not want to, if they were to do this, why they might limit themselves in terms of how high they go. But the point is that they don't have to do it at the current price. In previous instances where they've done this, they've done it at a higher price, and they might do that again.
Right.
Yeah.
Right.
And
So,
what could they do with that money, Adam?
well, I mean, they obviously have $37 trillion of debt.
Yeah.
You know, so, I mean, you
Why
kind
did I
of
even ask
start,
that question?
yeah, you kind of start there.
Yeah.
But yeah, Peter, do you feel like we kind of hit gold as an asset in the portfolio? Why clients should own gold? Why gold can make you money? Why gold can create a better risk-adjusted return for your portfolio over long periods of time?
Yeah, I'll just quickly summarize some of those key points. So, first of all, gold has outperformed the Standard & Poor's 500 in the last 25 years since the turn of the century. So, right off, just on that aspect alone, it probably may belong in your portfolio. But even if that wasn't enough, if you own stocks and you take those stocks and you blend them with gold, there's a really good chance that you may not only improve your rate of return, but you probably also decrease your overall risk because the two assets are quite non-correlated to each other. I mean, you blend two assets that are not correlated to each other in terms of their risk, you actually get a less risky portfolio overall. And then furthermore, beyond that, in the event that in the effort to deal with the high levels of debt, and in the event that the U.S. was going to quote unquote monetize their balance sheet, as Treasury Secretary Bissett said, there's the possibility that at some point, whether in the near future or distant future, that if the gold price was reset, that you can have an existential windfall inside your portfolio where you have returns that are far above what you ever really would have.
Yeah. Yeah. No, well said. Well said.
Yeah. Yeah. So, if you're like probably the majority of investors out there and you do not currently own gold in your portfolio, it could be something that you should obviously speak to your financial advisor or speak to your portfolio manager about, or if maybe you're not getting the answers that you're looking for, you can always speak to us, and we'd be more than happy to explain things.
Absolutely.
Yeah.
Absolutely. Maybe to kind of just wrap up this entire ideology, as being football guys here,
Yeah. Playbook.
imagine, you're on the football field and you have your star quarterback.
Yeah.
You call him Tom Brady or call
Sure.
him Lamar Jackson, but your multi-million-dollar quarterback,
Hmm.
and you're going out to win a game,
Yeah.
and you no longer have your left tackle on the field
Right.
or your left guard, and they need to block those guys. They need to stop those crises from happening. They need to prevent you from getting hurt. And how confident would you feel, Peter, going into a game without your left tackle and or even your left guard?
Having played football for many, many years, not confident at all. I mean, it just seems like an unnecessary risk. Why not have not just the left tackle there, but why not have the best left tackle that that money can buy in the sport of football?
Well said.
Yeah,
To
which is often the case, right?
to protect your blind side. That's why your left
Yeah.
tackle gets paid the most amount of money.
Yeah.
Absolutely. So
Yeah.
the take home from here, same thing in your portfolio. If you do not have gold, you do not have a left tackle. If you do not have a left tackle, you're putting your multi-million dollar asset base or your
Well said.
quarterback at high levels of risk that really doesn't have to be there.
Well said.
So yeah, hopefully this conversation today brings a lot of these points into, once again, obviously learning what is money, why is there demand for gold, why is gold going higher? Why do we think it'll keep going higher? And how does gold fit into a portfolio such that, once again, it can be your left tackle? And really, people talking about I want to be able to sleep at night. I can sleep really, really well at night knowing we have the best left tackle in football.
No, we got him actually sleep like a baby, knowing that we have gold inside of our portfolio protecting our client assets. And if we didn't have it there, I don't think I'd feel the same.
100%. 100%. So with that, we will wrap up. As always, please like and subscribe. It helps us immensely to find more people out there that are in need of these kinds of conversations to listen to. And we really enjoy being able to share this with you. You guys have questions, please leave them down below for us. We want to be able to answer anything that you guys have on your mind. But at the end of the day, if you share this also with friends that you think should hear this too, once again, that helps us immensely. So thank you very much. And until next time, see ya.
See you later.